Number one rule of Wall Street: nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Seems incredible, but we are already around Easter time. Who would have guessed? So happy holiday for those of you which are celebrating it. Hope you're gonna have a nice weekend. As for ourselves here, welcome back for another weekly market recap. It was a short trading week, so the market was closed on Friday. It was Good Friday, and quite honestly, there wasn't a lot, even from the economic calendar standpoint, right? Monday, a few Fed talking heads saying shit here and there. We got, I don't know, the ZEW economic sentiment in Europe, which just plummeted, I guess. I don't remember. I've seen these type of values. So might be we got a few other problems in Europe. At least, that's what the sentiment should reflect. Don't know how much I don't know if I would lean heavily on that type of a sentiment indicator, to be fair. It's not one of my favorite, just saying it. Now, what for the most substantial news, especially coming out of the US, we got retail sales, which came in very, very positively. Um, Again, I think a lot of it's just demand pulled forward. So, since we are still looking at March data, I mean, they are released in April, but they're relative to March. Could be, maybe. I would kind of buy into that narrative that people are trying to buy the things they need now because they are afraid that, because of tariffs, the trade war that was announced, they might go up in price, so might just as better buy them now up until they're quote unquote cheap, right? And other than that, we got more Fed talking heads, and even Powell actually gave a speech where he basically said no rate cut for now, and Trump wasn't, of course, wasn't happy. So other than that, what? Not a lot really. The the ECB did what? Did they cut? Well, it looks like they didn't. Yeah, 2.4. I mean, the facility rate, it's still two. No, they cut 25 basis points actually. Yeah, another rate cut from the ECB. Then what? Jobless claims out of the US, still they're still hovering around these values of, in between the 200K and the 240Ks for now. um I would say, I can agree with what Mike Green came up with. You're not seeing a lot of increase in the jobless claims because of the gig economy, right? So, the the Ubers of the world. So at a point, it's basically better to take on a secondary job, right? And starting to drive for Uber instead of uh, applying for your unemployment claims, because still Uber, believe it or not, it pays you more than the unemployment benefits. It's another narrative, I guess. He's not stupid, so I would assume he actually verified the numbers. And again, it's another type of narrative I might fall for. All right, considering what's going on in the world. Other than that, let's try to make it quick. A bit of a disclaimer: the video, it might seem long at first glance, but just bear in mind the charts, the different price action and segments and the asset classes. They are all condensed in the first 40 minutes, uh, more or less. The last 25, 30 minutes are all about a different topic on its own. And if you're just interested in the charts, as for the price action, you don't really need to look at the last 30 minutes of the video, which is basically about interest rate swap spreads. But if you want to check it out, go ahead. It's a very complicated topic, and I think it was worth to be discussed considering how negative they're going right now. But without further ado, let's jump into the charts. So a bit of a spoiler before actually looking into the charts. It was kind of a calm week, not a lot of movements. For many, this might have been some sort of a bless, I guess, after the huge volatility of the last 20, 30 days. So many different assets didn't move a lot, especially risk-on assets. Although, there were a few, just a few, which moved in a way which is worth considering, I think. But let's just start out, and as usual with the DXY, which again, it's one of those which didn't move quite a lot. So we closed down last week in here. Let's zoom in a bit. At support, basically, we had a tiny bounce and we are still at the lows. So usually it's not that good if you can't even put together a bounce, right? Although you have a bit of an inefficient price segment, which could be prone to a rebalance, kind of what we've seen in here. So again, the DXY looks weak. And as for the prior week, I'm not discarding it to come back down to 97, 96. But, just don't discard the way the DXY usually puts in the lows or, very powerful short-term bounces, right? It tends to go choppy a little bit and then it just makes up its mind and it goes one way or the other. So I would still lean to a bit more of downside here, not a huge amount, but a bit more of it, and then probably we can properly mean revert. So as for this week, not a lot. So if you remember last week video, I would say it's still kind of the same time of assessment for this one, which again should be reflected in the other ones. So the other major foreign currencies, they followed up the same trend to the upside, conversely, and doing the opposite of what the DXY was doing. So even in here, I mean, no major changes. You can just reference the previous week video. And I think, if you look at the euro, you look at the dollar Canadian, the Swiss franc, all of these, they're set up for a bit more of upside. I don't know how much yet, or still, before a major pullback and therefore a major bounce in the DXY. But I would go into next week with the same neutral slash bullish assessment for foreign currencies. So basically the opposite of the DXY. Just let's have a look at the pound, which was lagging a bit, but again, we said it seemed a bit primed to go up. Just we didn't like these spike to the upside and the absorption. Lo and behold, it came back down a bit, picked up new inventory at these levels, which were previously very interesting levels. As for the downside, right, this was the impulse of the last leg down. It was retested and it provided a bit of resistance. Price came back into it and spot on, it bounced up for what? 1, 2, 3, 4, 5, 6, almost 10 days. So not a good level overall on a higher time frame base, right? Let's move on to the other type of currencies. And again, these are a lot of currencies. I guess this chart is particularly confusing, too many things all at once, but you kind of see the same of what you were looking at on the other one. So basically, you see the Aussie dollar putting in a decent low in here and trying to break out of the high side of the range here. The New Zealand dollar already did it. The Mexican peso, it looks like it's trying to resolve this long-term consolidation in here and trying to put together a much extended bounce to the upside. Why instead, if you check the South African currency, it's still particularly weak in my view. Brazilian real is still in the middle of this range. It's constructive, I guess, because at least it looks like we put in a decent low right in here at the end of 2024, but we are just now going, we are a bit we are a bit trapped in between this previous dealing range right here and the low, which seem to be put in, right? So we'll see how it goes. But short term, I'd say neutral since we are in the middle of this range. So the only outlier at this point it's the Chinese yuan, which I mean, if you compare it to all the rest, it looks like the weaker of the pack. Again, we went over it last week or 2 weeks ago. It might be because of the tariffs, it might be because of this trade war and whatnot. But it's always interesting to check these currencies and see what they're doing. Now, before I forget, I wanted to say if they updated the dollar trade weighted index, right? Looks like they are, or they did. Yeah, they updated it. So let's zoom out on the weekly time frame. Let me check one thing here. Yeah, as expected, right? The DXY, which is majorly weighted against the euro and the yen, actually broke these lows on a weekly base. But if you check the other broad measure of the dollar, yeah, it came back down. Of course, as we've seen, all the other currencies are going up, so the dollar has to go down if they're all paired against the dollar. But you know, globally, the dollar didn't come back down at the same level you see the DXY coming down. So still, yeah, maybe the dollar is quote unquote crashing, but if you look at it from the perspective of all the other countries, you might just say, not all the crashes are the same, right? If you ask the Chinese yuan, it doesn't look like the dollar is crashing to them, right? So, it was interesting. I was just waiting for this update, but yeah, judging it on a weekly base, it's very slow. So, from time to time, just check that out. Let's move on to oil. Oil had a decent wick. I mean, it was looking like it was going to hell, or even below it. But of course, as usual, the farther it goes, the weaker it gets. What goes out must come back in, and all the rest of the good old trading cliches, which you can despise them as long as you want, but they work, which is why they are cliches at the end of it. Now, we started out the week, and I was looking at it actually on the 2 hours chart. It was this one right here, I guess, and I was observing these kind of a pattern right here, this formation, right? You see, it goes down massively, then you got a last push, an immediate bounce like this, and we hold. I mean, or at least we try to hold the range right in here, right? And we try to reaccumulate and go to the upside. So I do like this formation usually. So I remember on Monday I was like, you know what, we got a decent level right in here, which coincidentally it's just in the middle of the overall larger level, larger area on a macro scale. So if we can crack it, so let's say above 63, we might have a run in the high 60s and even 70s if things get a bit more crazy, right? So I was looking at this level above price action, and I was looking at this other one. And again, the let's call it the less probable one for the bounce would be this one right here, getting back into this pocket around 70. I am attributing to it a very low probability, but 66 in this area right here, in between 66 and 68, it would be legit for me if we can maintain this posture of, a low or a short-term low. We'll see about that being put in and price trying to reaccumulate after an impulsive move up. So it looks like whatever it was, we found a decent amount of liquidity at this level. Now that I'm looking at it, if you check this price action right here, goes down impulsively, immediately comes back up. I'm feeling like if we zoom in on these segment right here, we might see the same. Let's try that out just for the sake of it. Boy, oh boy, isn't it the same, right? Price goes sideways, pushes down sharply, it founds liquidity, so this is your peak up, comes back up impulsively, revisit the last, the base that was forming here, and it goes higher massively. Now, of course, there was news in here. It's not all about just simple price action, but yet it's kind of the same pattern. You see it on the 15 minutes, and then you see it on the 2-hour chart. Beautiful fractal right there. Which, by the way, this is what fractal nature of price is. It's not your Twitter guys taking a segment of 20 years ago and translating it to current price action, assuming that it's gonna behave exactly like that. No, fractal nature is actually the similar behaviors on a different level of magnification. So as in this case, you can see a similar pattern happening on the 2 hours time frame being repeated on the 15 minutes time frame. And the 15 minutes time frame overall, it contributes to the same pattern being observable on the higher time frame, in this case the 2 hours. I guess many people talk about fractal nature and they don't really have a clue of what they're talking about. But no rants this week. It's a holy week. It's holiday, so we'll try to be a bit more polite. All right. Let's move on to gold. Well, I mean, gold is just going up again. I think at a point we might see a bit of exhaustion even here. I don't think we're there yet. But again, just because I think we are not, it doesn't mean that next week you're gonna wake up to gold being down what $300 or something. I guess I mean, at this current time, given these current conditions, I would guess the only thing which could bring down gold like sharply, it would be some sort of a liquidity issue. What we had basically last week at the beginning of the week with the treasury market in the US taking the chance of freezing and the basis trade blowing up and all the people having to cover up the losses, force sells, liquidation. So something like that could bring gold back down sharply. Other than that, fundamentally, I don't really see a reason to be, bearish on gold for now. Might be different in 2-3 months, who knows? But as for now, I don't really see a reason. Now, let's have a look at copper real quick. I remember we were checking it 2 weeks ago. So, yeah, I mean, it put together a bounce in here. It's not, for now at least, it's not a huge bounce. We just rebalance back this inefficient move to the downside. So not conclusive in my view. What's interesting for me was, as you remember, sometimes we do check the copper to gold ratio. So we already went over it, so you should know what it is. If you don't, just pause the video. Here's the explanation for you, all right? But what was interesting is that it kept on going down because, of course, gold went massively up, and instead copper had that huge drawdown, and it didn't recover that fully yet. So, of course, the ratio is going to be down. It's down to levels which resemble the ones from April 2020. We're already below 2009. We are below basically 2002. I mean, so we are basically below levels which historically coincided with, not such good times in the economy and therefore the markets. So again, keep on monitoring. Ideally, if you want to be kind of a bit more bullish, not only on the markets, right, but on the real economy as it is for real people, not just investors and speculators, you would like to see these ratios starting to go up a bit. All right. If you want a bit of a reflation or a bounce of in economic growth and whatnot, right? But I also checked silver this week because everyone was starting to talk about silver. We got this massive sell-off in silver too, and although silver is another precious metal, and it's a lot similar to gold, right? It's a precious metal, but at the same time, it has a bit of characteristics which makes it useful in the manufacturing process, especially in the industrial process. Now, of course, we got a ratio for copper to gold, but we got one chart of a ratio for gold to silver, right? And this ratio just spiked to the upside with this move down in silver and the consequential, or it's not consequential, but the relative move up in gold. Now, the explanation that the website provides you basically says that you should have a look at this ratio because usually they are very much correlated in price action, given the fact that they're both precious metals. And so investors usually use this ratio to kind of grasp the relative strength of gold relative to silver. And then they go on and buy silver because they think silver is going to lag the gold price action and therefore will follow up. That might be one take on it, but to me, I know it might sound a bit silly, all right? I get it, but let's try to think about it this way. Let's say gold is your Bitcoin, right? And silver is your Ethereum, right? So the two top dogs of the crypto space. I mean, I don't even know if Ethereum is still a top dog, but it's an old narrative, right? Bear with me. If you see Bitcoin, in this case gold, going massively up, but at the same time, the number two not following, actually taking the opposite route or path, what would you infer? Because for me, it would be a measure of risk off. People are basically flying to safety. And I know it sounds stupid again, but if you think about the crypto ecosystem, Bitcoin, it's kind of the safest asset in crypto, all right? Kind of like gold, it's a safe asset, right? They're flying to the safe asset, to the safest and most liquid asset, so Bitcoin and gold, and they are dumping what they now deem as, don't want to say completely risk on asset 100%, but less safe and liquid asset, which in this case would be silver and Ethereum. If you check this ratio right here, over the last 15 years, when we've seen it spiking it, we have seen what? There was a spike in, February, end of February 2020. And we know what came next, right? There was another one, right? Oh, look at that. What was that? August 2008. In September, it was hell in financial markets, if you remember those times. So, you know, it might be a little bit of a warning sign. I guess, again, this is just something which the website doesn't tell you, but, sometimes you just need to find out different reasons instead of taking at face value what is stated on a website or in a manual or in a textbook, so to speak. I just found it interesting to some degree. We'll see how it plays out. It might be I'm totally out of myself and just throwing out a lot of crap, but I just wanted to put it on the radar for those which maybe weren't aware. All right. So after silver, and since we used the crypto space for this metaphor or analogy, let's have a look at Bitcoin. Didn't move a lot again. So again, remember last week analysis? It's kind of the same. Um, Up until the point we are below this area, nothing huge. But at the same time, if we can stay above this level right here, still that would be more on the bullish side of things. I would just wait for this range to resolve itself and showing signs of willingness to go up, willingness to break down. Probably it's going to follow what the rest of the market as for risk on assets is going to do. So, although the user talks about decoupling, yeah, whatever. I could agree to some extent, but still my base case, it's still they are both in the risk on asset category, so Bitcoin, equities, so they're gonna move together overall, like in the grand scheme of things. Could they be kind of like decorrelated or inversely correlated in the very short term, like 1 week, 2 weeks? Maybe, yeah. Sometimes it's just a matter of rotation, even inside the vast uh, equity market. You see the different sectors sometimes being being traded differently, right? Sometimes energy goes down, but staples go up, right? Or sometimes uh, real estate goes down, but technology goes up. So, it's the different sector of the same category, the equity market, but inside of it, you have rotations and different assets trading a bit differently in the very short term. Then if you zoom out on your weekly or monthly chart, you see them moving together more or less, which is kind of the same take I would have on Bitcoin versus the rest of the risk on assets. All right. So that would be it for the initial part of the charts. And we're going to get back to it, taking a look at stocks. And at the end of it, rates. All right. So let's have a look at the equity market. Again, spoiler alert, not a lot, really. We basically stayed all the week, which again, it was a short week because, for Good Friday. So just 4 trading days, we stayed in these last Friday's range, basically. We just had a lot of inside bars compared to this one. But again, I mean, this is just what I do. It doesn't mean that you have to do the same, but I was just looking at the range of the massive green candle after, the 90 days tariff pause. And my premise was, okay, up until the point we are in the upper half of the range, I would be generally bullish. And if we crack below it, I would become generally bearish, aiming at a retest of the lows or around the lows. Right now, ended up last week saying I think the market will just try to get back in balance. At the end of it, we just tapped into resistance, so a bit of our rejection was due. I guess many people had the expectations that this market would have resolved itself very quickly. But if you remember, I was a bit more on the neutral side. This is it, basically. I guess sometimes you just need to be patient a little bit. Um, and again, as for the price action, my general stand was just you need to be a bit more bearish at resistance usually, right? So expecting a complete bust through at first pass. In my experience, it's not that common, right? Doesn't mean it cannot happen, but it wouldn't be my first bet, which is why I was more neutral than anything else. Um, Plus, fundamentally, as we've seen with the copper to gold, the silver to gold, what we've seen in the treasury market last week. I mean, those are not things which just go away in 1 week, or in this case, 4 trading days. You need to give it a bit more time to these things. Otherwise, you take the risk of jumping the gun one way or the other a little bit. All right. Now, what what's next? Um, I don't know. Quite frankly, I don't. And the best part of it is that I don't need to know it. All right. I would just reiterate my previous week analysis up until the point we crack this area right here, or right here, or right here. I would keep on betting on a reaccumulation and a retest of resistance. And in this case, we might pop a bit higher than that, right? If we crack it, then very short term, I would bet on a retest of the lows. So I would trade throughout the day for those targets, which means, selling the rips instead of buying the dips. But you need to consider that we are talking about a range now, which is what? Let's just measure out NQ for the sake of it. And you see that we are talking 2,000 points, more or less, right? Yeah, on ES, what are we talking about? 500 points. So although it doesn't seem like a lot on the daily time frame, if then you zoom in on your lower time frames intraday, and considering that it's pretty much still volatile intraday, you have a lot to work with, right? So once you can establish your bias for the session of the day and decide what type of trades you want to favor, just longs or shorts, you got your work for you, and you can work with that. You can make wonders with it. Now, speaking of volatility, what do we see? Well, we see, of course, the VIX coming back down a bit while price action gets a bit more stable, right? Which is kind of normal in this case. I guess, everyone was hoping for the VIX to cool off a bit. We went over the stats for what happens after we get those spikes in the VIX. I found a new one, and it's not bad, but again, you need to give it time. It's not something which resolves itself particularly quickly. So this is maybe not really for traders or short-term traders. It's a bit more for position traders or long-term investors. But I mean, at the end of it, you see that overall, when you got those massive spikes, at the end of it, the result, it's kind of positive. Now, the problem is what's going to happen in between that spike and the possible bullish expected or hoped resolution, right? Just give it time. We'll see what's going to happen. Another thing might be we are still kind of in a bearish posture if you look at the moving averages. One thing about moving averages, now everyone is starting to talk about the dead cross, right? If you check the yellow moving average, this is a 50 days simple moving average, or at least it should be. Should I check that out before looking like I'm up it? Let's see. Yeah, it's 50. All right. Or maybe not. Could I look like I'm up here? Is this one right here? Let's see if it changes. Not really, so I guess it was good. Yeah, I mean, should never doubt myself, I guess. So I was just curious because every time we got these massive crosses, right, and the newspapers start talking about them, it's just like the herd mentality, in my view. And I'm not saying that it doesn't work or it didn't work historically, right? But I was just curious to go and check how well it worked. So let's take this the SPY chart right here. Now, bear in mind, we are looking at the yellow and the purple right here. So first of all, the cross is happening while price action is pretty away from the moving averages. So we are already kind of deviated out from long-term moving averages, which usually would suggest a mean reversion, actually. So not a continuation, but it's an average, right? So price over time will tend to gravitate around it, right? So that would be my first counterpoint to it. The second would be what? Let's see if we got a previous iteration of it. Last time we had a dead cross was in 2022, right in here. Well, guess what? The moment you got the cross, it was the low. And how much did we bounce off of it? It was in here. So we bounced, let's say, it doesn't need to be exact, but let's say it was from here, right? Your casual 8% bounce on SPY. Now, sure, of course, eventually 2022 turned out to be a bearish market up until the end of the year, the Q3, Q4. But you know, the actual cross, it wasn't the best time to short. If then you say, yeah, but it was setting up the stage for the rest of the year. Yeah, absolutely. But it was a terrible timer. That's kind of my point here, right? Do we have something very similar? I mean, we got the COVID dump, but I mean, was it an outlier a little bit? You don't get to see the global economy being shut down every day, right? And even in this case, when we got the cross, the low was already in, and we were trading back in the base basically before shooting higher and go for one of the most beautiful bull markets of history. All right. Another one was when? This one right here, 2018. Again, very similar setup to what we are looking at right now. Uh, Trade war, Trump in office. Although this one right here, see one difference is that when you see the cross, price is pulled back into the moving averages. So we are not deviated out of the means or the long-term averages, which leaves the doors open for an actual expansion rather than a mean reversion. So in this case, I guess it worked out perfectly. At the end of it, again, it was kind of short-lived because the cross was December the 4th, the low was December the 24th, or the, yeah, 24th. Oh, nice Christmas gift. If you buy on Christmas Eve, you're set up for the next what? Well, next 2 years almost, right? Not bad. But again, less than 1 month afterward, you got the lows and price just go up. So again, I was just trying to look at it to have a little bit of a measure of how much weight would you put on these crosses, especially in order to manage your positions. Because one thing is having a bias, one thing is the intraday, intra-week, intra-month volatility and different price behaviors you can see, which could completely destroy you if you trade just based on one single data input like this one. Like even in here, we got what? The cross happening. And basically we got the lows, which are already in. Now what you say is, yeah, of course, but after the cross, we actually push down a bit more. Yeah, so as a short-term trade, it would have worked. Yeah, I guess it was, or it would have. But overall, the lows were already in, and then we just went up again. Now, of course, it was kind of a difficult period back then. You were just coming out of the European sovereign debt crisis, so it wasn't like the ultimate low and then price just shooted to the upside solely. You had another retest of the lows. Overall, for like 2 years, the price stayed in this range. But again, without getting too boring about it, just to say that when you see something like this happening and you see people starting to talk about it and being particularly vocal, and you see the mainstream media, especially your Bloomberg, your CNBC and whatnot, I mean, just put on it the weight it deserves, right? Then if you see price action actually having a bounce, retesting the cross, so one of the two moving averages, and being rejected, now you got confirmation and you can say, yeah, you know what, guess the cross was right, and we are now entering a structural bear market. kind of like what we had in 2022. All right. But up until that point, just because they are crossing right now, or they crossed what 3-4 days ago, don't think that just because of it, price needs to shoot and to shit itself right here, right now. That was my argument right there, right? So that would be it for stocks. Not a lot, as we've seen. If you want to zoom in on the intra-week movements, we started out with a gap to the upside on basically, well, NQ, yeah, yes, yeah. The Dow, yeah, even the Dow, but the Dow was a lot weaker, right? We went sideways, we retested the previous week close, bounced, tried to go up once again. Then in here, it was in between Tuesday and Wednesday, we got an announcement of another type of a chips ban. Basically, was the United States saying, Nvidia, it might be forbidden to sell these precious high tech chips, GPUs, and technological equipment to China. And the problem for Nvidia is they committed to invest 500 billions on land in US, and the day after the government strikes them with basically a measurement which would hit the company for what? I guess it was 5.5 billions in revenues only in Q1 or in Q2. I don't remember, but very short term, right? So I mean, of course, the stock just plummeted, and the following day, the entire stock market was down. Then we gut filled, we failed because we were rejected in the gap, and then we went down on Wednesday. Thursday was just another type of rebalance, and then back around the lows, but ending up the week with a little bit of a bounce. So as we've seen, particularly neutral week, all things considered, and I guess we just need to wait for new price information as for now. So that would be it for stocks. All right, not a lot, although even if it's not a lot, I can manage to talk 20 minutes about it, right? Let's now have a look at the yields that we left out in the last spot for this week. Now, yields really didn't move like a lot. Yeah, I mean they came back down, and then on Thursday they had a bit of a bounce, especially the long end. The medium end it kind of fell back into the range. The short end it's still particularly subdued, and you see this discrepancy by which the short end is going down. At least it looks like it's having still this downtrend going on, while the medium end it's a bit more range bound, even on a higher time frame base, and the longer end it looks like it's still instead on an upward trajectory. So I left the entire thing at the end of the video, not because something went on and it was particularly incredible as for the price action, both in the yields and therefore in the bonds, right? But because I've seen something is going a bit viral right now, and I wanted to touch on it at the best of my abilities, which might not be incredible, but I wanted to give it a go because everyone is starting to talk about it, while instead that was actually a thing all throughout the past few months, if not the last 1-2 years maybe. And what am I talking about is interest rates swap spreads. Now, before we go on, I'm sure if you want it, like in plain English, you can just reference Mr. Jeff Snyder at Eurodollar University on YouTube. And, full disclosure, these slides are taken from him, all right? The ones he put on YouTube, not the ones in his, private service, right? So it's all publicly available. I'm not breaking any copyright or something. So what is a spread? Now, you do know what's a spread if you think of when we were checking out the spreads or, the credit spreads. So basically the spreads in between private and corporate debt against US Treasury, so government debt. All right, it's kind of the delta, it's the difference. All right, here it's kind of the same, although this time around we are measuring the spread in between the yield on whatever type of instrument you would like to pick as for duration. So it could be your 3 months bill, your 2 years treasury bill, your 10 years bond, or your 30 years yield bond, right? Bond yield, right? And oftentimes, like in this case, they are picking up the SOFR, so the secured overnight financing rate, as a benchmark for these spreads. It's again the difference in between these values, right, and the same value as for the fixed rate of the interest rate swap contract. Now, I know when you say it like that, it sounds a bit complicated, but if you just bear with me for a minute, we'll get there, all right? So first of all, a bit of history. Swap spreads have been with us since the dawn of time. The first one was actually executed in 1982, although the date it's a little bit blurred here. But you can just read the two parties involved and the dealer, which actually put them into contact. It was Lehman Brothers, which arranged the the transaction and all the different type of bureaucratic arrangements. And the two party involved were Sallie Mae and ITT Financial. I don't need to go over it completely. You can just pause the video and read it. And basically, what is an interest rate swap? Well, it's just two entities which are exchanging an interest rate. So I agree on paying you a specific rate, and you agree on paying me another. Now, there are different forms of swaps, right? The most used and the most commonly and widely proliferated, it was the plain vanilla spread, in which one of the two counterparties actually commit to pay you a fixed, and the other one it's committing to pay a floating rate. Now, this distinction is important because not only this is the basics of the swap itself, but the fixed leg of this transaction, it is also what is used to measure the spreads. So when they are talking about swap spreads going negative, they mean that the fixed rate of the two-leg transaction in the swap contract, it's now set up at a level which is below the correspondent yield on the treasury, which you pick based on the duration you want to give to the contract, right? Or in this case, the SOFR rate. So that's basically what you see on the chart. You see the difference in between the fixed side of the swap of the interest swap contract compared to the corresponding maturity of the treasury, the bill, or the SOFR you're looking at. That's it. All right. So why is this market important? Well, because if you look at the volumes, it looks like there are currently, at least last year, it might be different this year. It could be a bit more, it could be a bit less. I would bet it's a bit more, but I don't have the data right in front of me. Just for reference, though, we are talking about almost 600 trillions of dollars, which are put in these derivative contracts, which is kind of like a lot. And just for reference, if you think when people say, yeah, the US Treasury market, it's the most liquid and it's the biggest market on earth. Yeah, remember the numbers, almost 500 trillions. This is your global bond market. The US bond market, it's 51 trillion, right? China, it's 20, 21, something like that. The rest of the world, it's 12 trillions. Canada is 4 trillions. The United Kingdom, 4.3 trillions. We are talking about almost 600 trillions right here. Okay, so this is why people pay attention to it. This is where monetary matters are actually dealt of. All right. Now, but in practice, how does this swap actually work? I made a little bit of a schematic right in here, right? So just a summary of the whole, which is very complicated, all right? Not only because, as I said, there are many different types, the plain vanilla, or you could have floating for floating, or you could have your basis trades, your basis spreads, whereas you are just swapping one yield for another. Do you remember we were talking last week about the basis trade? And one of the way by which you can perform that carry, that basis trade, is by buying into the yen denomination or short, basically being short JGBs, and then on the other side buying US Treasuries, and you're pocketing the difference in the spread. Right? It's kind of the same in here. Many different type of swaps that you can have, but the plain vanilla is the most used, and it's the easiest to understand if you're starting out, as I did. All right, because again, I just studied these things with a bit of help on the internet, a bit of a paid subscription, and a lot of time, and a few headaches here and there. All right, now you got, of course, the two entities. All right, A and B, which in the case of the historical reference could be Sallie Mae and ITT Financials, and they commit in a contract, whereas one of the two it's paying a fixed rate to the other, and of course the other is receiving it, and in this case A, after he pays the fixed, it receives the floating, while B, it receives the fixed and it pays the floating. Now the two parties are using a dealer for it. Why would you want to use a dealer? Well, look, the problem with these things is that it gets very complicated. So you need someone which is specialized in it, first and foremost. The second aspect of it would be that if you have a dealer in between the two counterparties, which can basically guarantee that both are gonna honor their side of the contract, the two parties they don't even need to know each other. All right, it's like when you go making your trades, whether you're trading futures, currencies, metals, commodities, do you know who is selling those contracts out to you? No, you don't care. You're operating with your broker, right? It's kind of the same premise here, because if you had to know exactly who are you buying from and who are you selling to, would it be more efficient or less efficient? So this is why you got a dealer in between, for technical reasons, for trust reasons, and also if we zoom out a bit, because the dealer is actually organizing the different expirations, the payments. It's making sure that each party is making the payments he's basically obliged to, right? So this is the basic schematics of it. Now, a few premises that I highlighted, right? The fixed rate is set up at the beginning of the contract and it never changes. So once you get into the swap, the fixed part of it never changes. Otherwise, it wouldn't be fixed, right? The floating instead, it can be anchored to whatever type of duration you want. So as I was saying in the beginning, it could be your 3 months bill, the 2 years note, the 10 years note, the 30 years bond, whatever. Or as we've seen, the SOFR rate. Again, the secured overnight financing rate. If you lack a bit of context on these terms, SOFR is just an interbanking type of overnight rate. All right. It's kind of like what we got in Fed funds. Fed funds is an overnight rate at the end of it. SOFR is the same, just instead of being the ones which is applied when you interact with the Federal Reserve Bank, it's the one that you get when you interact with the interbanking system. All right. Before SOFR, we had LIBOR, and there was a huge debacle, a huge scandal around it, which is why it was replaced by SOFR. But enough of it, right? Just know that it's an overnight rate. It is secured because pretty much after '08, all these transactions now are secured. It means that they are collateralized. You need to post collateral or a guarantee to make sure that if you default on your obligation, the counterparty will be able to be paid in full by just dumping the collateral and be made whole once again, right? Now, again, the two sides, they don't need to know each other. They use a dealer or an intermediary, and the dealer, of course, it's operating as we described, and it is not usually, it's not applying a fee, but it's pocketing a spread, right? So that's kind of the very basic, right? The very basic mechanic of it. Now you might ask the why people would feel the need to engage in these sort of transactions or contracts. Well, there are many different reasons, all of which are particularly complicated, all right? And you actually don't need to know them in order to understand why, if the swap spreads are going negative, it's a bad signal or is a signal in and of itself. But just for reference, it could be for hedging risk, okay? It could be to balance out operational cash flows. If you want an example of it, let's say you run some sort of a entity and you know that your outflows are fixed, like you know that you need to pay a specific amount of payrolls every month or every year. You need to pay a specific amount of uh, I don't know, it could be payments on the loans that you got to in order to start your business. Then you got other fixed expenses. It could be your mortgage and whatnot. So on the other side, you might have an income which is kind of how would you say that? It's not certain, right? It depends on many different circumstances. So what you might try to do is to get to a point where you want to counterbalance your income side in order to match it up with your liability side and don't have your balance sheet upside down. So you could do it by taking one of the two sides of the transaction in here and making sure that maybe you want to receive a float, which is going to increase your payoff if the other conditions which would put you into trouble, given what we've said, would deteriorate themselves. So you try to balance things out, right? Or it could be to access credit, because let's face it, if you are, let's say you are a very small business and you don't have access to the credit market to the same degree one big institution might have. Well, then you can just interact with one of these institutions and they will provide you access to the huge credit market at a favorable condition, because maybe the floating rate is set up in a way which is basically lower than what you would get if you would go on your own into the credit market. Since they don't know you because you are too small, they might charge you a higher rate just for a matter of trust. I don't know you, or I can't really guarantee you're going to be solvent at the end of it. So I need to ask you a bit of a premium on your financing rate. But guess what? If someone else, which is very known, which has a reputation, is going to ask for the same type of financing, they're going to provide him a lower rate, maybe just because of trust. And then you can interact with this person or this entity and agreeing on one of these contracts by which he's going to make sure that the loan that he took out on your behalf is going to be, let's say, paid because you are paying the fixed, right? Which could be the same of what he's paying on the other side, right? Or with a little bit of a premium even here, but yet overall you're going to end up paying less instead of the situation whereas you go on your own into the market, right? And you're going to receive your floating. So, you know, you're going to make sure that you're taking in the money that you need, and this side of the transaction is covered. So entity B is safe, entity A is safe. The dealer is pocketing the spread, and everyone is happy. You got access to credit, and this party right here, it's providing you that access by covering its risks and maybe taking a little bit of a haircut on you, right? So again, don't get too specific with it, but just understand the first part of the entire diagram right here, right? So once you set up a fixed and a floating rate, this is what you get, right? When the contract is actually incepted, the fixed rate, it's basically set up at a level which it's gonna even out the profit zone and the loss zone for both of the parties involved throughout the duration of the contract. Now, of course, this is very schematic, and we do know that in this case, the forward curve, it doesn't stay fixed, right? We know we got fluctuations. It could be economic variables. It could be just the central bank moving rates up and around, right? It could be many different things. But, ideally, schematically, that's kind of the most simple example you could have. At the end of it, no one is really losing or making money on it. As we discussed, they're doing it to get to other comparative advantages, all right? Or, satisfying different needs which go beyond the simple profit or loss taking, right? But again, reality strikes back. So we do know that this forward curve is going to move. So if it moves up or down, it could be that this profit loss zone, it's going to change for those party involved. Now, getting back to the point of the initial chart, if you think, or if you want to bet that rates into the future are gonna be lower than now, well, what you want to do is engage in a transaction where you pay a fixed, all right, and maybe you receive, well, it is actually the other way around. You would want to engage in the transaction by putting yourself on the side which receive the fixed, all right, because you think, if rates go down, I'm gonna, since I'm paying floating, all right, what's gonna happen is I'm gonna receive the fix which is set up now, and let's say in this case it's 2%, but then if rates go to, I don't know, 1.5%, 1%, I'm gonna pay 1.5 or 1. So I'm pocketing that 50 basis points or that 100 basis point spread. I'm receiving 2%, and yeah, at the beginning of the contract, maybe the two things are even out and I'm paying 2%, but I'm betting on the fact rates will be lower. So over time, throughout the duration of the contract, there is going to be more time where I'm paying the fix, which is, well, I'm receiving the fix, which is 2, but what I'm paying, which is the floating, is going to go down. So I'm pocketing the spread. I'm making a profit, right? So my edge will pay off if the rates go down in this case. But what happens, if you think about it, right? What happens when many other people like you are going to start to take the same bet, right? Accepting or demanding the fixed rate to be paid to them and be willing to pay the floating? Well, up until the point you have someone else on the other side of the trade which is willing to receive the floating and paying you the fixed, it's all well and good. These fixed rate, it's not going to move, right? But the more people are going to demand to be paid the fixed, and the less people are going to be willing to pay them the fixed, it could be just, a supply demand imbalance. A lot of demand for fixed, and in this case, not enough people able to guarantee they are going to pay that fixed. How do you even that out? Well, essentially, if there are less people willing to pay the fixed and many more people demanding to receive the fix, you need the fix to be brought down, because those few people which are still willing to pay you the fix are going to say, you know what? Yeah, I mean, I could do that, but I'm looking around and it looks like there are not many people which are willing to do that. So if I'm doing it, why would I pay you, let's say, 2%? Nobody else is willing to pay you that. You know what? Let's make it, I don't know, 1.75 or maybe 1.5% if you want to receive a fixed for the next 4, 5, 10, 20 years. I could do that at those conditions. So, I'm taking a little bit more of a margin for myself, but I'm still providing you the fixed. Is that what you're seeking? All right. And what do you think is going to happen next? The fixed is moved down, right? So if we said that the fixed is moved down and the fixed is the value, it's the rate of the transaction that you use in order to then compare it to the corresponding duration, so your SOFR or your treasury yield, right? Well, it's going to go down. If you look at the spread, it's going to go down. Not only this fix is moving lower, it's moving lower in a way which is going below what you could get if you just buy and hold the corresponding duration treasury. And now the question is, okay, but wait, then why people would agree on engaging in this massive complicated transaction just to get a fixed rate, which is what they're seeking, right? Which is lower than what they could get for the same duration if they just buy and hold a treasury. The reason is because they think rates are going to be lower. Therefore, they're going to receive more than what they're paying out, and they're pocketing the spread. It's still another form of an arbitrage into the future, right? Again, you might say, sure, but if I just buy the treasury right now, well, if then rates go lower, my treasury is going to appreciate in price. Yeah, I mean, that is true, but in this case, you're not taking on the same amount of risks because you're not really taking on the risk of what we've seen lately. If bonds sold off massively, you don't really become a forced seller of the underlying security or treasury in this case, because you're still in these contract, in these transaction, which is just a swap. The worst that could happen to you is that instead of going like you planned, the forward curve actually goes up and you end up paying a bit more than the fix you receive. But that's a different type of risk that you can assess. Or maybe you just prefer to do it this way. Or again, getting back to the diagram, at the end of it, you don't really care where the treasuries are going to trade at or where rates are going to go. You just need to hedge your risk, comparing it to many different aspects of your business or your balance sheet or your cash flow, right? But the bottom line is that when you see these spreads going negative, that's basically the market, a vast majority of the market telling you that they think rates are going to be lower into the future. All right, that would be it, which is why everyone is freaking out when they see swap spreads going negative, but at the same time they're looking at the actual yields, and they see the yields which are particularly elevated. Now, historically, if you check, at least in recent history, let's say the last 15, 20 years, sooner or later, yields actually followed what swap spreads were doing. So that would be another case for lower rates into the future. And, it's kind of what the market is betting on at the current moment in time. Now, I know it's not really easy to understand, and I know probably I'm not I'm not the best person for the job. Um, mainly for I don't know, a bit of a language barrier here and there. But I guess at the very least, if you leave out all the schematics and all the different reasons and plumbing behind why would you engage in these transactions, but you take away just the latest part, right? what does it mean if these fixed side of the swap transaction are going down, and how do they relate to the corresponding duration treasuries, and what is the signal that the market is giving out? That's kind of like the core of what you should take away from this, right? So as for the rest, yeah, yields not moving a lot, if not the short end, and we'll see if, at the end of it, who's gonna win it. Rates are very discussed right now, especially with all the fight in between Jerome Powell and President Trump. They're getting into a situation which is not particularly cool, but I mean, we'll see about that. We are already too deep into this video for being a short week where basically nothing happened. Right? So hope you found it interesting, and quite honestly, I would encourage you to check out Jeff Snyder at Eurodollar University on YouTube. If you want to dive a bit deeper into these matters. And other than that, I wish you're going to have a nice weekend, time with your family, festivities, and whatnot. We will be back next week and we'll see what the market does after this short trading week. And as usual, be nice, be cool, and have fun. News out.